Welcome to the Expert Exchange. I'm Lindsay Melchek. Sitting with me again is my partner in crime, Michael Succurro. Michael and I have spoken continually about interest rate cuts and the new 30-year amortization program, how the U.S. election is going to affect investment strategies, and so much more. So today we're conversing about rent forecasts and REITs. So hello, Michael. Great to see you again.
Great to see you again. Thank you for having me back.
So, okay, let's talk about this latest one right now. I know that we've spoken about so many things, but I just recently read a report of this research that was done by Erkan Yoden, and he's an associate professor at Concordia's John Molson School of Business. So Erkan actually used machine learning to model growth in rents using housing and census data and immigration and population projections. Now, according to research, the average monthly rent could reach $7,500 in Vancouver and $5,600 in Toronto by 2032 if current trends in construction and population growth continue. So, Michael, what did you think of the research?
You know what? A lot of people may disagree with me or may be a bit upset, but I agree with his research. You know, it only makes sense, especially given just, again, looking at the mortgage side of things. Take a mortgage right now at $1 million, 4.5% rate at a 30-year amortization, you're at $5,000 a month in a mortgage payment alone. So you look at a lot of these condos, let's look at the Toronto market. Take a condo, they're going anywhere from $800,000 to $1.5 million. So you're in and around that $1 million mortgage range. And that's just a $5,000 payment just for the mortgage without property tax and without maintenance fees. So if the price per square foot is going up in Toronto, it only makes sense the rent eventually does have to increase, especially due to the fact that we're not building wide, we're building very narrow. So again, majority of our population is in that Southern Ontario range, and we're not looking to expand any further north, especially for the time being right now when it comes to the green belt and many other stipulations when it comes to transportation as well. So as we continue to condense these tall skyscrapers in these small areas, again, it only makes sense what the research is saying, that the rent is only going to go up, supply and demand, simple as that. Given
the projections in this study, what role do you see private equity real estate firms playing in addressing Canada's housing shortage?
Well, what I'm seeing is there's a larger shift now with individual investors and these private equity firms into the multifamily space. So looking at these properties and taking advantage of the new rules coming in where they're able to put more than 4 units on a single lot. It's become very popular in provinces such as Alberta. It's becoming very popular in British Columbia as well, and here in Ontario. And ideally what they're doing is they're investing in these properties that have 15, 16, 17, 18, sometimes even 30 units attached to them. So it creates a larger rental income. It's a lot safer for the investor, given they have, let's say, 15 units in there that are out for rent. So if one person, 2 people miss their payment, you're averaging out as still getting a decent ROI versus having that one singular unit as an individual investor, where if that person doesn't pay the rent, and we all know how the tenant control is here, you may be sitting back for months, even years, until you're able to remove that tenant and get the money back from where you lost on that rent that wasn't paid. So these private equity firms are moving to these multifamilies as it's just becoming very exciting and is very drawing to many new investors.
So are current capital markets doing enough then to bridge the gap between the supply and the demand?
They are. Like we're seeing, again, speaking on just Ontario, British Columbia, and Alberta, there was a big push to moving, there's a big push to moving along the bylaws to push for these multifamilies to be built on single dwelling properties. So you take your property that's 65 by 130 feet. They're now allowing in certain cities to build multifamily residences for a certain depth back and obviously a certain height moving up, which does assist with adding more of these units, which makes it a lot easier to add more of a supply versus your traditional way of just simply building these 55-story skyscrapers that take a lot longer to build, a lot more funds are needed to go into them. And again, a lot of people are losing faith right now in purchasing condos, as we're seeing many are coming out to the market and the sales trend is dipping in the condo market. Whereas you take your single dwelling family home, knock that property down, and you're able to put 5, 6, 7 units on there.
You see it from the builder's side of view where, they actually run out of that invested money and then the project just sits stagnant for who knows how long.
So exactly. And they go into receivership, and we see so many of that in Ontario and British Columbia right now.
It's wild. And so in this research, the model suggests a significant rise in rent for major cities like Vancouver, like Toronto. So what specific changes or policies do you believe are required to accelerate housing development and prevent these sharp increases?
Well, first, before we get into that, like what I like to explain to a lot of investors, and I have a lot of conversations on this topic, is you want to scale back and look outside of Canada. You have cities like Tokyo, New York, Boston, Los Angeles. Their average rent right now is anywhere between $3,000 to $4,000 USD for either a studio apartment or a single family apartment, single bedroom apartment. And if you actually look at Toronto and Vancouver, I feel like we're still on such a micro level of what we should be growing to, and especially compared to these other cities that we are compared to many times, especially when it comes to New York, Tokyo, and Los Angeles. So I feel like we're actually still very far behind in what the rental income should be, or the rental property should yield for you. And I still think it's a great time for investors to actually get into these properties. Now, in terms of policies, what we have to look at is looking at restrictions on these tenants. Now, what happens is you go to these bidding wars is because these tenants are looking for, these landlords are looking for AAA tenants. And the reason for that is I feel we have, again, very unrestricted, very loose rules when it comes to the tenant-landlord relationship. So what happens is they're increasing the price and they're putting the stipulation that, they want an 800 credit score and great income. These landlords are underwriting these tenants like they're underwriting a mortgage. And that's unfair, especially to these immigrants that are new to Canada, don't have a credit here, don't have an established income yet, but they may be great tenants. So I feel like if we had a better policy in place protecting the landlords, it would actually be more beneficial to the landlord and the tenant on an overall.
Okay, so with the election that just happened, immigration is a huge piece of the pie on the plate. So with immigration and population growth projected to continue, and maybe off the tailwinds of what's coming down the pipeline from down south, how might real estate investors and developers adjust their strategies to meet the growing demand? I mean, is there a greater opportunity for REITs and institutional investors in this scenario then?
I think there definitely is, because now, again, with these new policies changing, allowing more people to build these multifamily properties and adding more units to even single family homes, I feel like there's a large enough gap to be filled by these micro investors, these micro REITs that are not your larger companies that are coming in and building skyscrapers or building, 100,000 acre subdivisions. So they're able to come in, pool money together within a REIT and work on 4 or 5 different multifamily projects. They're going to generate a yield of 10 to even 20% a year, which is amazing. And what's also great is for a lot of investors that are seasoned and looking for less risk-adverse real estate investment without having to actually own the real estate themselves, or new investors that don't have enough capital to purchase the real estate themselves, a REIT is just a perfect opportunity to come in, whether it's $50,000 or a couple $100,000, to have that safe investment that's, again, backed by real estate that has a tangible asset there that you can touch and feel while making a great return.
Yeah, I mean, it sounds like, it may be one of the ways to get into the market in Toronto, in Vancouver, where you're being bid out left, right, and center. For our audience that doesn't quite know what a REIT is, can you give us just the Coles notes of that?
Yeah, absolutely. So a REIT is a real estate investment trust. And what it is the syndication of funds. So we would open up a fund where we would be purchasing multiple properties. And instead of you being an individual landlord, you'd invest money into this fund that's going to be purchasing set type of properties. So they may have different offering memorandums. A REIT may be for multifamily purposes, it may be for storage facilities, or it may be for commercial plays such as commercial plazas or large big box stores like Walmart, Costco, and many other big box stores. And what you're doing is you're actually investing into this REIT, and think of it as a mutual fund. That's how I like to explain it. When you're purchasing a mutual fund, you're buying 8 to 10 different stocks. So when you're purchasing into a REIT, you're investing into 8 to 20, even 100 different types of properties. And the beauty of that is your risk level actually comes down a lot more, because going back to being a single property owned landlord, if that one person doesn't pay you rent, you got to come up with the money every month to pay all your bills. Whereas for a REIT, if that one property, or maybe that one unit within that property is not paying rent, you still have many other tenants in there that are paying rent, and you're still able to keep up and also still generate a larger ROI.
Okay, that totally makes sense then. Okay, so let's dive a little bit into, what we can do for housing collaboratively. So We know that governments alone cannot bear the burden of increasing housing supply. We know that. How can capital markets, particularly through REITs and other investment vehicles, be incentivized to take a more active role in building affordable housing?
Yeah, it's a great question. I think they could be more incentivized by, again, offering lesser restrictions when it comes to, the red tape around developments and how long it takes. In Ontario, we call it a big carousel. You jump on that carousel to get one permit, you finally get it after 6 months, and the carousel keeps going around as you're waiting for more and more permits. And that's what I feel like we're lacking in our country as an overall, is that we have the capital, we have the skilled trades, we have the builders, we have the investors. We just need our policies to be a little less restrictive, or maybe just a little bit more clear and concise to make it a lot easier for these individual builders to start building more properties for this immigration wave that our government's trying to bring in. Because again, you're leaving it to these big builders that are sticking to these modular homes or these condos, where again, you have these small REITs that could come together and purchase these 20-unit multifamily properties that is more than sufficient, especially in small towns where a lot of these immigrants should be going, instead of going all into Toronto or all into Vancouver. You're actually able to, lessen the stress on all of the utilities, transportation, food, energy, technology, if we're able to actually allow these builders to build in these outside markets to take off the pressure from these larger cities like Vancouver and Toronto.
I mean, that would also build the economy across the country, not just in specific regions. So if we highlight how low vacancy rates are distributing traditional supply and demand dynamics, can you expand on how this has shifted the outlook for real estate investors and whether rising rents might make Canadian cities less attractive for new entrants?
Yeah, absolutely. It goes back to talking about your average price for a mortgage. So again, it only makes sense if these builders, if there's less of a supply and there's more of a demand, the price is just going to keep increasing. And that's the worry right now with the rate cut, is that we're already seeing a bit of an uptick in sales prices again because the rate cuts are coming down so low. And we need to mitigate that to ensure that we don't overinflate these properties again like 2020 and 2021. So what happens here is that these rental prices just need to increase because there's only so many properties in Toronto, and we're pushing, again, all these immigrants into Toronto that it only makes sense. There's not enough supply, so much demand, and the cost to hold that property, again, on $1 million mortgage with maintenance fees, with property tax, your monthly cost is anywhere from $7,000 to $8,000 on that property. So even if you rent it out at $5,000, you're still at a net loss of $3,000 a month. So it just doesn't make sense to want to own that property and be a landlord. Where again, going back to the REITs, where you're investing your funds, someone else is taking care of the property management, someone else is taking care of the renters that are coming in. You're making a great return, just like any other investment in the stock market or a mutual fund or even a GIC. You have less risk, still a greater reward, and having these REITs come into play may also lessen the rent increase. Again, reason being is that they're not looking to be greedy because they have a multitude of properties versus just one single property. So they're able to filter through these applicants a lot better, able to have a better application process and a less biased application process. Because again, it's a big organization that's going through these applications versus one landlord that just says, hey, this is what I want, and I'm not going to budge with it unless I get an 800 credit score, great income, and $5,000 a month.
Yeah, for me, I cannot wrap my head around the fact that these landlords can now sit there and ask for credit reports or whatever it is that they want. It's definitely raised the stakes for sure. So tell me this, with rents expected to reach unaffordable levels for many, so what investment opportunities might arise for those looking to develop or finance housing projects? We talked about REITs, we talked about other things. Is there an innovative financing mechanism like green bonds or public-private partnerships offering a viable solution?
Right now, there's not many viable solutions that we see here, unfortunately. One that we've looked at in the past is a rent-to-own program, which I think can be very incentivizing to, again, newcomers to Canada because they don't have that down payment to get into that property. So that could be one investment tool. And the rent-to-own, not to go very deep with it, but just to give you a Coles Notes, is it's almost like a vendor take back. You're setting up a certain amount, saying, okay, a certain portion of your rent is going to go towards rent, and the other portion is going to go to chipping away at the equity of the property. And then, let's set a 10-year, 15-year contract in place Once you chip away at X amount, then we could talk about the final number you have to go get at the bank as a mortgage to actually close on this property. So that's one way real estate investors have been making a play to have a great passive income and slowly look to exit that properties. They don't want to be landlords forever.
Now, Michael, let's quickly chat REIT stats. Can you give us, the year over year and the projections going forward for REITs?
Yeah, absolutely. So when we're looking at a lot of these top REITs in Canada, if you actually look at the year to date from right now, a lot of them are ranging from a 12 to even 40% increase in the last year. And funny enough, a lot of people actually thought they were going to struggle given the rate increase. But you have to understand a lot of these REITs go into a fixed rate option, and a lot of the times they actually don't even have a mortgage given the fact that they're taking in funds from investors to buy these properties outright. So what had happened in the last year is, given that mortgage rates were increasing, a lot of people were not entering the market. So what were they doing? They're renting. So it's so funny enough, it's actually an opposite correlation of the rates. The higher the rates went, what it seemed like the trend was the higher the increase was in the overall value of these REITs, given that more people were being pushed into the rental market versus purchasing their own home. So yeah, it's been a great return, and I think it's going to be a consistent growth for these REITs in the upcoming years, given the fact that we are slowing down maybe a little bit on immigration, but we've already opened up the floodgates. There's already been a big influx of immigrants coming to Canada, and unfortunately, affordability is looking less and less closer to new first-time home buyers or anybody looking to enter the market. So it just might make sense to actually enter into the rental market. So investing into a REIT, I think, is definitely going to be a safe shot for the next 5 to 10 years, given where our market is headed when it comes to the increase in the rental market and the need for housing for these new immigrants to Canada, and also, again, just your under the age of 35 population that simply can't afford to purchase their own home right now.